Yes, good evening. So, coming back to the weekly podcast that we are going to see that how quantitative tightening ends. I think that we all know that the Fed has started shrinking its balance sheet from the June 1, 2022. What are the things that we have to note from the history is that first of all, John Maynard Keynes, Fabian socialist and godfather of modern day economic planning, wrote in the General Theory of Employment, Interest and Money, right, that practical men who believe themselves to be quite exempt from any intellectual influence are usually the slaves of some defunct economist. As we know that the Keynesian economics has been followed by a lot of nations, that fiscal stimulus will stimulate the economy back into the perfect condition, which was followed in the Great Depression in the 1929 US. We have to go to the history back to the 2008 when the financial crisis was ravaging in the market in the US, which was spreading around the world, especially in the credit markets. So, in the late November of 2008, then Federal Reserve Chairman Ben Bernanke committed a fate compilation. Though he may not have realized it at the time, he was blinded by his scholarly prejudices. As we know that Ben Bernanke was a economics professor in the Stanford University in the California. Bernanke, a smack and the Great Depression history buff of the greatest academic pedigree, gazed back 80 years, observed several credit market parallels, and then made a preconceived diagnosis to the 2000 financial crisis. After that, he picked up this desktop copy of a monetary history of the United States by Milton Friedman. As we know that he is one of the monetarist economist in the US. He also influenced some of the Chicago boys who experimented that kind of economic theory into the Latin American countries, especially the Chile and some of the countries like Peru, etc. So I think that Bernanke first let the quantitative easing genie out of the bottle with the purchases of 600 billion of mortgage-backed securities and treasury notes in 2008. So Bernanke is the first Federal Reserve Chairman to do that in a fashion. To implement the quantitative easing program after Alan Greenspan. He is the one who initiated this QE, and he could be thinking like the father of QE. But you have to see that the Japan, which has been experiencing some kind of deflation from 1990s. Which is doing the same thing in the Japanese stock market and bond market. They are suppressing the yields of bonds, which triggered the massive volatility in the stock market. So Japanese stock market always moves up. The bond market usually the yields will be going down. So by March 2009, Bernanke had run up to Fed balance sheet from 900 billion to 1.75 trillion. So then over the next 5 years, he ballooned it to $4.5 trillion. All the while, he flattened his ego with platitudes that he was preventing Great Depression party directs. Did it ever occur to Bernanke he was merely postponing a much needed financial liquidation and rebalancing? Or that his actions were further distorting the economy and setting up for an even greater burst? First of all, I have to see that the QE, which triggers the balance sheet expansion, as we see today. So perhaps Bernanke understood exactly what he's doing. Remember, the Fed works for the big banks and big money interests, not for the main street. So that was the main thing that many main street people from the workers area just accused the Wall Street for all the messes that happened in the 2008 financial crisis. So apart from that, moreover, when the day came to straighten things out, Bernanke was gone, which is going to happen in the credit markets even today after this pandemic ended and the QE, which was going towards end. And you have to see that Janet Yellen, now Treasury Secretary and former Fed chair from 2014 to 2018, was tasked with contracting the Fed balance sheet from $4.5 trillion 8 years after the Great Recession, which she eventually does. And you have to see that some of the major Wall Street bank heads were just cautious of ending the QE. Jamie Dimon, CEO of JP Morgan Chase and Company, advised caution at the time. Speaking at the conference in the 2017, he remarked that we have never had QE like this before. We have never had unwinding like this before. Obviously, that should say something to you about the risk that might mean, because we have never lived it before. When that quantity tightening QT happens of size or substance, it could be like a little more disruptive than people think. We act, we know exactly how it's going to, and we don't. So he was cautioning against the QT in 2017. Diamond's words caught the attention of Representative David Kutchoff of Tennessee. The following day, during Fed Chair Janet Yellen's semi-annual congressional testimony, Kutchoff asks if she dares uh, uh, and shares Diamond's concerns about moving assets from the Fed balance sheet. So Ellen didn't provide an explicit yes or no, but she did use an uncanny flair for using to reduce all the disagreeable repercussion of Fed prior actions. So she said that we have tried to be very methodical about informing the public and the markets about how we are going to do that. We have provided essentially complete information, and we have not had significant concerns or seen a significant market reaction. This is exactly the opposite to what is happening today in the markets. As we see that quantitative tightening has pushed into the started, the markets have been behaving very negatively for the past 1 month. So to Ellen, the act of QT was a methodical endeavor. We have to be thinking the past, that what was these guys were thinking. So even when with an absolute elaborate plan to see the through. On Wednesday, September 20, 2017, you have to very keen on this line. As the Fed was gearing up for QT, Fed Chair Janet Yellen attempted to clarify how the Fed was going to do it. Following the two-day FOMC meeting that we have seen in the last 1 or 2 years, that we have cautiously watching it, the Fed issued its customary statement. Therein, it mentioned that balance sheet normalization would be initiated in October of that year in 2017. The reference implementation note outlined how the Fed contract its balance sheet. Effective in 2017, the committee directed the open market desk to roll over at auction the amount of principal payments from the Federal Reserve holdings of Treasury securities maturing during each calendar month that exceeds $6 billion, and to reinvest in agency mortgage-backed securities the amount of principal payments from the Federal Reserve holdings of agency debt and agency mortgage-backed securities received during each calendar month that exceeds $4 billion. This is not very important thing that you have to note, but what are the things that Fed essentially does is that the normalization would behave like that we have seen in the last 3 or 4 months, as we all know. Moreover, in the Fed's June 2017 normalization plans, it identified plans to increase its initial 10 billion balance sheet contraction, 6 billion in treasury notes and 4 billion in mortgage-backed securities. So this is the small thing that we have seen, because today we are seeing very big thing, because the Fed has expanded its balance sheet from 4.5 trillion to $9 trillion. So I think that then it planned to let it back to normal, though it was never clear what normal was. It doesn't know what the normal was, which you have to see that what is happening today. By back paper calculation at the time, starting with the initial October 2017 $10 billion reduction, that incrementally increasing the reduction by 10 billion each quarter until hitting 50 billion per month, and then contracting by 50 billion a month, that it would have taken a 70 minutes for the Fed to get balance sheet back to $900 billion, roughly where it was Bernanke fight accompli. Thus, in March 2024, monetary policy would have been back to normal. The balance sheet size was just only 4.5 trillion, and it would take 78 months for the Fed to go back to the normal of $900 billion. So that was the master plan at least, but the master plan was an epic fail. You have to see that QT was abruptly terminated and reversed in September 2019 after just 24 months, which is very laughing by the financial analyst. The Fed balance sheet stands at $3.7 trillion. Initially, the Fed reversal was triggered to provide the liquidity needed to cover repo madness, because the repo market, if you recall, sometime between the night of September 16 and the morning of September 17, 2019, the overnight repurchase agreement rate hit 10%. Short-term liquidity markets essentially broke. Before long, the Fed was supplying hundreds of billions of credit every night to keep credit markets flowing. You have to see that I'm saying that the credit which usually flowed in the market which when the QT was happening, the credit market was just flood, which triggered the economic collapse in the real economy, because the credit was not flowing. It was flowing at a rate of 10% per interest. So soon after this, grossly overwhelmed by coronavirus pandemic, the Fed went balls to the wall and expanded its balance sheet by $5 trillion. A good part of this took place between March and June 2020. By the end of May 2022, the Fed balance sheet was over 8.9 trillion. So you have to see that Fed just doubled its balance sheet from 4.5 trillion that it expanded in 2014, and then it reversed it 3.7 trillion to just over $9 trillion. How quantitative tightening ends? You have to see that the inflation rate in the US before the Russian-Ukraine war was just 8%. Sorry, it was 7%, and now it is around 8.3%. So the final part is how quantity tightening is going to end. This painful account was provided for several reasons. First, to point out that the world does not operate according to plans and contrivances of central panels. Second, to provide context for what the Fed says it's doing and what will actually happen. You don't have to know. Even the Fed chairman, Bernanke, Janet Yellen, and Treasury Secretary, you have to see that today's Fed chairman Jerome Powell didn't know what is the outcome of this quantitative tightening, because you are attacking the credit market. What happened is that the banks which having central banking operations which will having some interest rate liquidity will be tightened up when the interest rates is going up. So that's what happened in the 2019 market, and the balance sheet was stopped at $3.7 trillion. So on the Wednesday 1 of 2022, that is this month, 5 days before, J. Powell said Fed initiated QT. So we all know that the Fed started the quantitative tightening, which is very, very important event, as we already know about it. The master plan this time around is for the Fed to reduce its holdings of treasury notes and mortgage-backed securities by a combined of 47.5 billion per month for the first 3 months. By September, the total amount to be reduced will go to the 95 billion, 60 billion for the treasuries and 35 billion for the mortgage-backed securities. Okay, according to the Wells Fargo Investment Institute's calculations, the Fed's balance sheet could shrink by almost 1.5 trillion by the end of 2023, taking it down to around 7.5 trillion. So, what are the odds that Fed contracts its balance sheet to 7.5 trillion by the end of 2023? You have to see that it just only reduced its balance sheet by just over 1%. Yes. What are the odds? We have to see that the Fed normalization policies are doomed to fail. That is the main thing we have to see that. To put things in perspective, it took 24 months for the Fed to reduce its balance sheet by 800 billion between October 2017 and September 2019 in the wake of a 3.5 trillion expansion that we have set. And this QT program was abruptly ended in repo madness. So it definitely attacked the credit markets. You don't have to have a projection when it will end, because it won't happen overnight. It won't happen very in a short period of time. It will take some time to end this madness, because when the balance sheet was 4.5 trillion, it took 24 months for it to come it around the balance sheet by just $800 billion. So you are just wanting to do that, you have to reduce it very fast. When you are doing it very fast, it will attack the credit markets, that we said. So now it plans to extinguish nearly double the assets in 19 months. It is just a very, very funny thing to think about in the markets. You have to denote that this is a very comical thing that the Fed has said, and very analysts are saying, because without understanding the history. I have been reading this article, very interesting article today. This was not shared by anyone, because the Fed started initiating the quantitative tightening, but no one can identify when it will end in a fast or a slow manner like that. So finally, I have to summarize here. So we know how QT ends. So first of all, at least the interest rates will rise. Okay, interest rate will rise by when the inflation is hitting 8%. The Fed wanted to normalize the inflation. It just wanted to rise interest rates. So at asset prices, as we know, the equity, stocks, bonds, and real estate will eventually going to fail, eventually going to lose its value over time. Credit will contract. You have to see that credit will contract like the economy upon right under from. Credit markets will it will tighten, which will be seen in the bank's repo operations, which will be triggered into the economy, and the credit market, which denotes that the banks are not willing to lend money lower at rate of interest. So high yield bonds will collapse. The high yield bonds, which have a difficult time to pay their interest, the deleveraging process of American companies will be rising. So the bond market will be reflecting this definitely, which we have seen today. So GDP will definitely going to decrease. Unemployment will increase in the face of declining labor participation, because you have to see that the companies will reduce the capex at the rate of interest is rising abruptly. Numerous cities and several states will go bankrupt because of the high interest rates. Normalization of Fed policies. The Fed will not doing QE because it just wanted to push the bonds into the market. You have to see that after maturity, it will cut back the balance sheet reserve and the asset side of the balance sheet and the liabilities of the balance sheet. It just didn't roll over the bonds into the next month. So these are the things. Once again, I have to summarize here. So the author has very clearly stated here. So the Fed will abruptly reverse course, but it will stuck at some point. It will stuck at some point. That some point would be the recession or the stagflationary environment. So this will debase your money, your time and life. So this is the final thing that we are going to see in the next couple of years. We don't know when, but we will definitely see it. Thanks for the weekend podcast. We will be updating more interesting articles in this voices in audio format in the coming weeks. Thank you.